All right, team. Welcome to the weekly webinar here. Today's date is 12/6. 12/6, the first week going into December. Wow. And there's a lot of lessons this week. A lot of good things to take away. And that's the beautiful thing about trading is it's an everlasting process of growth. And you're going to make mistakes. And the important thing is being okay with making mistakes and finding out their mistakes as soon as possible. Right? Because mistakes is what end up costing us our sanity, our capital, and but the thing is, with every mistake or every loss, there's a lesson, right? With every single one, right? There's always an equal and opposite. We just have to be able to dive deep into it and address what's going on. And there's been a lot of lessons that I've been able to take away from this week, and that's exactly what we're going to go over. Key number one lesson is, and I teach this to everybody in my mentorship program, is step number one is identify healthy and unhealthy opportunity. I can't stress this enough, and this is why it's the first step in every single in every trader I work with's journey, because until you are able to avoid bad market conditions, I don't care how much money you make, you'll lose all of it, right? Like, we have to set the expectation that trading isn't an everyday thing, right? Like, we got to be realistic. If we want to be the top 1% and make the top 1% of money, and we actually want to do well in this game, we can't behave like the 90% of people that lose, right? And that's when I ask myself genuinely, what does the 90% do? Right? They're getting in the market at every chance they can. They don't filter out bad days from good days, right? They're trading for adrenaline. They're trading to trade. They're trading to satisfy an itch. I know this because I was this trader for a very long time, right? I was the trader that was addicted to price action, addicted to the toxic relationship in the market. So in this webinar, that's really is the primary focus, is knowing when to trade and when not to trade. And that's where we start to use our tools, right? Like, how do we know when to actually pull the trigger? Now, I just had a great session, and in that session, we talked about the criteria, right? What do we look for to pull the trigger, right? This is going to consist of three things, right? The critical level, right? In this case, we got open print right here. We got previous day low. We have end of day, and we have previous day high, okay? So on this day, we're gapping down tremendously. We're actually opening below previous day low right here. So this is bearish so far, right? We open up. Now, price rips off the open, and we get a very nice push up, okay? Now, what can we take away from that first little move? That the open is relevant, right? Well, the open's always going to be relevant. But I guess what I want to get at is, why do we actually use it? We use it to identify opportunity, okay? Now, on this day particular, I took a long play. Where was it? Right here to the upside. And it was because we used the critical levels and the moving averages and the RBI and GBI to paint that story, right? So every time, this is how I do it every single day. I identify my levels, open, previous day low, EOD. So how I'm looking at this is there's a bullish and bearish scenario, okay? If I need to figure out who's controlling this to either trade down or to trade up, right? But we use the open as the benchmark, right? It filters out the balance in pre-market of all the market auction, right? The orders, right? The open comes, it's got tons of volume, and it's going to paint the picture. So what do we use to understand the picture? If I got to figure out if this is going down or up, what do I use? I use the RBI and GBI. Right? Here's our first one right here. We get that clean red bar that's ignored. Draw our zone, right? It's on the 5-minute time frame. Draw our zone, and now right here we have what? Our area of value. So we get a really nice push here in the morning, right? I didn't get in this. I didn't find anything good off open print. Off the 2-minute 20, and that's something that we're going to talk about here in a little bit. But I didn't take a trade here in the morning because of it, and there was no moving average cross, so I was kind of looking for that as well. And I don't like longing into previous day low, right? If this is previous day low, that's telling me that we're bearish. I'll long when we're already have that buying acceptance above PDL, then I'll start looking for a long. So I didn't take that long. Price comes in back into the AOV, which is just textbook blueprint buying right here. And then we get another RBI, which leads to another area of value right here, which is why I took the market long right here, right? So if I draw my zone above this RBI, this right here becomes our area of value. Price comes back into the AOV. And guys, check this out. What are we doing right here? We're not closing outside of the 20, okay? So this is on the 5 minute, right? 20 works on the 5 minute as well. But notice how we can't close below it. This is how we use our moving averages, right? So if we use critical level, open print, PDL, then we use the RBI and GBI to identify the AOV and the area of value and the opportunity itself. And now we also can use our moving averages. Do we have to use all of these all the time? Well, we don't have to do anything, right? And that's what leads me to what I really also want to talk about today is like the market doesn't really care what we want. We use criteria to filter out bad trades, right? Now, we're not always going to get perfect criteria, and the criteria is not always going to work. But we need to be able to use it in a manner that keeps us from trading that horrible price action we've been seeing, right? So that's where I took the market long. I took the market long right here. Once we've pretty much established that buyers had the ball and the 1 hour trend was close to price, right? This guy right here, we're hovering right there around price. This helps me understand we have a healthy trend, okay? And that 20 holding really helped me as well. So I was able to take that long, and then there were multiple times this day that I was able to trade off the 5 minute 20, right? So we got another RBI right here where I was able to take another long as well, bouncing off the 20. Now, you know, you're not always going to get the perfection, right? This is a perfect example, right? This long play. So we got the red bar ignored right here. Buyers are trying to push. And we go long off the 20 right here. And my stop loss in this case went right here. Right? So we have to remember, if we're trading off the 2 minute 20, you got to stick to the 5 minute RBI for rules, right? I mean, there's nothing wrong with putting your stop below this guy. But remember, the market really, you know, it's gonna respect the RBI maybe a little bit more than your moving average, right? Nice retest into the area of value as we tried to make our way up to end of day. We didn't get up to end of day, and then price ended up reversing, and that was Monday. Monday, believe it or not, in retrospect, wasn't horrible price action. Not as bad as Tuesday. Look at this. Look at this mess. All right, this is absolute trash. Now, once again, this is going to happen. The market has been super indecisive. And can we control that? No. Like, we have no control over this. The only thing we can control is how we navigate it and how we execute it. We have open print, multiple moving average crosses here, which should have stuck out to me. I took a long play right here after that RBI, which in my defense, this is my strategy, right? This is exactly what I look to trade. What I really liked about this was how this candle right here, this red candle right here, if you drew a zone around this, we bounced off it really well. Now, the market just didn't have follow through. It completely reversed. There were multiple things that could have helped me notice maybe it would have been better to stay away on this day. All these moving average crosses tell us what? That the dominant force can't hold the ball that long, right? That's the purpose of the moving average cross, to help you understand who is more dominant, who is stronger. So if you're getting multiple back-to-back moving average crosses, it's probably because the market's in really shitty environment and we shouldn't trade. Now, that doesn't mean if you see 2 moving average crosses, don't trade, right? But if you get 4 within the first hour, that's probably a good indication that the market is going to be probably pretty choppy. But for whatever it is worth, I took a long play right there, and the market ended up turning and started to reverse. Now, the beautiful thing about our strategy is if you use it, you'll be able to avoid most of this horrible price action, right? There was no RBI or GBI to the downside, so no trade there. Same thing up here. Same thing down here. Just not getting any RBI or GBI. We did get an RBI right here off open print, but the 1 hour trend was not what I really wanted. You can see here, guys, how the 1 hour trend is actually trending down here. So once again, these are just tools that we use. So when the 1 hour trend's trending down, I'm more looking for short plays here, right? Off the 20 here to target downside targets. But then when we pop up above that 1 hour trend, now I want to be a little more hesitant with buyers because, you know, the market's trending down. It's just a nightmare. You can see we're getting multiple moving average crosses. Right here, I took a short play, right, which looked to be very nice trade. You see here we come right into the 20 EMA on the 5. We get a really nice green bar ignored right here. And the market just didn't really have the follow through, right? We got the push into end of day, couldn't get below end of day. Market then ripped right up on us. And that was pretty much the story of Tuesday. Just absolute garbage. And I mean, look at the microphone, right? This is a chart pattern that we should always stay away from, okay? It's called the microphone. I don't know if it's really called the microphone. I just called it the microphone because it kind of looks like a, what is this? One of those like sound horns, or the volume speaker. Looks like the volume speaker. Okay, when you're getting higher highs and lower lows, something's wrong, right? Like we should be able to notice this, right? Like this is not ever a market you want to trade. If you were able to avoid price action on this week, you did a phenomenal job, right? Of, you know, patience, discipline, everything. Just really bad price action there. All right. Tuesday, Wednesday. Wednesday was another day that wasn't really the best. And if you, for whatever reason, were well, let's just start from the beginning here. So once again, we have our key levels, right? We got previous day low, and we're opening up right next to it. We got end of day right here. We're opening up right next to it. And we have previous day high. So it started out looking completely fine. We have open print. We come up and we start to sell off here. So things are kind of looking not too bad here, right? And hold on. Let me just check everyone's mute. Okay. Appreciate you guys. All right. So, you know, things look pretty well. We're bouncing off end of day. Moving average crosses, or moving average, the 20's holding. Everything looks fine. At this point, I'm looking for that bearish scenario, right? Like, once again, every day I'm either looking for a bullish or bearish opportunity. And in this case, I'm looking for a bearish one. And then, boom, buyers show up very strong. Now, we get really extended from our moving average, right? And this is what happens in these markets, right? We get very quick moves up, followed by equal and opposite moves down, which makes it very hard to make money, right? If you're not taking profits quickly on days like this, it's very hard for you to make money, right? Even if you had a perfect entry, right? Think about what you would have to do to make money in this price action here. You would have had to went long off the low here that didn't even retest the low, right? Like, really ask yourself, if I was going to make money here, what would have been possible? You would have had to make a perfect entry here off a low that didn't even retest. So once again, right, like, there is no opportunity here. It's not just because the strategy is not present. In my opinion, it's impossible to know when the low is if the low isn't even going to retest the low perfectly, right? So there's no opportunity. Price rallies up into the 1 hour trend. We get some selling, and we get a red bar right here that's actually ignored, right? It's disrespected. So now I'm looking at this. I'm like, all right, cool. This is our strategy. This is the HVT cross. We get a rally up. Let me whip out the 2 minute because I was really focus on the 2 minute this day, which is why I didn't trade it. And I'm looking. Oh yeah, this is what happened. So I'm looking for a 2 minute 20 retest to push me to enter into this position, and this is the candle we get. Look at this candle. Look at the wick. This wick alone is $1. Okay, on SPY, which is very large. On $1 wick. So there's no way I can participate in that. But the area of value was respected, and that's what I took from it, right? So once again, if I'm seeing an RBI, I have to identify the zone, and this is why. Look how it was respected. Even though we fell below it here, we didn't disrespect the candle below it. This is buyers creating demand. Okay, cool. So now once again, I'm looking for long opportunities. And I just didn't really want to participate in any of them because of how large the candles were. Right? Like, if it's our job to manage risk, Wednesday was a horrible day to do it. We did finally get a good opportunity right here around 12:05. And, the key thing I want to take away and talk about here is just how well the zone was respected. Okay? Like, this is why I use them. I use them because they help me paint the picture of who's in control. Even though the market is super choppy and it's all over the place and it's hard to really get an entry, you could have still been able to know buyers were here, and I'm not gonna go short, right? I'm just gonna try to trade with buyers here. But there was just no good opportunity, in my opinion, especially off the 2 minute. I took a couple longs up here. I took a long right here. Okay, that's where I went. That's where I went long. So I went long on the 2 o'clock candle, but I took it on NASDAQ. But it was the same thing. But once again, it was off a critical level, right? This is previous day high. There's an RBI right here. So here's the AOV. Okay, and then here's the retest. That's lining up with the 20 EMA. And then we get another RBI out of it. So when we retest it, I just want to be crystal clear right here, because an entry here and an entry here is gonna change the whole thing. I literally entered into this as soon as price came into this ALV and started to respect the moving average. Right? That's exactly where I got into the trade. It was right here on this candle. So once this candle closed respecting the moving average, I'm entering in to the market long. I'm buying my contracts. Once that closes, I'm buying the contract and I'm putting my stop here. This takes a great deal of acceptance. A lot of us like confirmation, and we want to see it continue and hold, and we want like a little bit more. But what I noticed on days like today, on this day, right, it would usually move about what the previous candle moved and then start to reverse. And that's what we seen. We literally rallied all the way up to the high. And then what happened? It started to come down, and so on and so forth, right? So not good price action whatsoever. But we were able to get through it without getting completely killed. Thursday. All right, I took 3 trades Thursday. Once again, approaching the market with a little more caution. And it's not like necessarily caution. It's just like, for me to actually participate, I just really want to see my strategy. And I just want clear, I don't want very large candles, right? Large candles lead to choppy price action. And why though? Why? The reason, really genuinely ask yourself, the reason why a large candle is going to lead to chop is because every time you get a very large candle, what's happening? We're getting super extended from a moving average quickly, right? It's like an imbalanced movement. When we get that crazy push fast, look where the average price is. It's way down here. So price is going to either suck back to it or remain choppy until it comes back. That's why, if you guys take anything from this webinar today, that's why trading next to moving averages is very important. It doesn't always need to be the 2 minute 20, but make sure you're close to some sort of moving average when you're getting into the market in these current markets. Because you want to capture the large movement away from the moving average, right? You don't want to get in after the large candle and hope there's follow through, because there's not much follow through lately. All right, let's talk about this day. Took a short play right here. Definitely reversed on me almost immediately, and once again though, I'd say it was a pretty good trade. I wouldn't really change much about it. It had, nice momentum here to the downside. Hold on, let me see if it'll let me get it. So, all right. So it looked like this right here. Okay. So this is what it looked like when I actually entered in short. Nice moving average cross, no RBIs or GBIs. And we finally get a GBI right here. But I'd say we're kind of too far away from open print, too early. But the 1 hour trend kind of made up for that, because when the 1 hour trend is close to your price, you typically are going to get a price to continue to move down. So I was completely fine with that. Took a short play right there. Boom, get stomped out quick. Now, once again, this is why our strategy is going to sustain longevity in the market, and it's because when you're wrong very quickly, right? If I'm getting into a position because of a GBI, I'd probably get out of a position because of an RBI, right? And that's how you want to look at it. If I'm entering in right here on this candle, on this red candle, I'm entering in, I should probably get out as soon as the next candle wipes the top, right? Because that's how it works. That's once there's an RBI or GBI present, we know one side of the market's trapped. I need to abort mission. So I was able to get out of that, and then I was very hesitant. As you can see, the 20 is just not being respected here. It is, but it's just not. It's like flat. And then we finally get this glorious move to the downside, right? We get that clean green bar ignored off EOD. And just look at the difference here, right? Like, look at where the 9 DEMA is, right? It's right next to price action. It's on price action. This is healthy. This is not healthy. Look where the 9 is here, right? We're very extended from it, right? When we start getting extended from that blue line, chop is present. Look at here. We're on it. We're not extended. And we got a clean green bar ignored right there. We hop in short. Rode this down. And then I rode it up. And this is something that I don't do often. But I did on this day. If you drew a trend line here, you would see this is what the market looked like when we hopped in short. So when I'm getting in short here, I'm going, and my bearish target's down here. I'm going, all right, we might get a move all the way down to the bearish target, but we also have this trend line here that's kind of playing a unique role. Once we broke out, we couldn't really get sustained buying, and then boom, price drop, fell right into the trend. And once it fell into the trend, look how far away I am from my 1 hour moving average. 1 hour moving average is up here. Okay? Look how far away we are from the 9 DEMA. Okay? We're what is that? $3 away from it? $2 away? $1.50 away from the 9. $2.50 away from the 1 hour. So I'm like, all right, there's a lot of opportunity there, and I know there's a lot of rush sellers. So that's when I whipped out the lower time frame, and I was able to spot buyers holding this little zone right here. Okay, like look at that. That's very clean. And I was like, you know what? I'll long into the 20 and the 1 hour, and I was able to capitalize on that move. And it's because my risk was super tight, right? My risk was super tight. So that day was really able to help me, help me out this week, right? just to you don't need perfection. You just need a couple really good trades. But all right, Friday. Let's talk about Friday, because Friday I wasn't that proud of the way I traded. So Friday we got really good price action, right? We got clean red bar ignored off previous day high, off open print, and it was also respecting the 20 on the 5 very well. I didn't take this, and for what it's worth, the market's been extremely choppy. So I really wanted that more. I wanted that 2-minute 20, right? I wanted which we kind of got. Look at this. We got the bounce off the 20. It was just in the middle of the RBI, and then by then it was already too far, and I didn't want to take it. And I did a lot of deep diving into this, and there's something that that's important that I want to talk about, and it's for my people that are trading both futures and options, this is definitely where you want to listen up. So, futures trading requires very precise entries, right? If you want to pass these challenges, you need precision. Options trading, when you're building your own cash, you don't need precise entries, right? You can risk a 5-minute candle drawdown. Futures, I'd argue that you can't. Now, both are great ways to trade and make money. But if you are doing both, you need to differentiate your style to match both, right? And what I mean by this is you can't always apply options trading principles to futures, and you can't always apply futures trading principles to options. That doesn't mean one's better than the other. All what it means is you got to become really clear on why you're pulling the trigger to get into a trade, and you need to become very clear on which one you're working on that day, right? Now, for me, I like to do both, right? I love growing my cash account. I love making my money on options, and futures is also great, but this is something I worked on and put a lot of work into and dove into. If you're getting an RBI off a key level and it's respecting the 20, you should be taking this long, right? If the context is there, you should be taking it. If you don't want to risk that on futures, then don't risk it. But also accept the fact that you might miss out on a really good move. And that's what happened to me on Friday. I missed out on 2 of them. Look how good this 9 was on the 5-minute. Super healthy. There was a lot of good things about this trade, and I wasn't really able to capitalize on it. I was able to capitalize on a short play later in the day, which happened right here off NASDAQ. And then I also traded Tesla, right? And Tesla, I also fumbled the ball because of I was trying to use both principles. But we got this red bar that was ignored. I went long right here, and I got clipped right here. Now notice something though, guys. The 5-minute RBI never broke, right? So for what it's worth, remember, if you're entering far away from a moving average, just remember that the pullback to it's probably going to happen as soon as you get into the trade. And that's what the banks are supposed to do, right? They're supposed to stop you out and then let it continue further. We ended up getting back into the market as I realized that this ALV kept holding. I got into the market like right around here, and then we were able to capitalize to a nice move up in the high of day where we trimmed. Good move on Tesla right there. And then for the rest of the day, it was pretty much trash. So key takeaways from this week is that the market is, I'm hoping that it starts to come out of this, nasty decisiveness or indecisiveness. If you'll see here on SPY, you can see that we're ripping up into the highs. But the key things I want to talk about is know why you actually get into the market, right? If you're getting into the market because of a 3-step approach, don't compromise it, okay? If you're trading both options and futures, make sure you differentiate which one you want to be your primary focus that day and run with it, okay? Be careful using the 2-minute. Don't always expect perfection off the 2-minute. It's not going to happen. For a while there, we were getting tons of beautiful 2-minute 20 retests, and I think we're going to get them again. But the moral of the story is don't get frustrated if you don't. Learn to walk away, protect your capital, and learn and continue to trade, right? Don't force hop into things early and get frustrated because you're not getting what you want.